every single metric that we could possibly use to measure the market, whether it's occupier demand, investment volumes, pricing, rental growth, vacancy. They're all at record levels. So the question I'm asking myself now, more than ever really over the last 2 years, is, well, how long is this amplified state going to continue? And what are the implications of what we are seeing in the wider economic sense on our world, on our market? So just to get the ball rolling, I'll just, a quick recap on where we got to at the end of 2021. We had 40 million square metres of new leases signed across the continent in 2021. That's a new record for new logistics take-up across Europe. On the capital markets side, we have 62 billion euros invested. Again, a new record in terms of how much was deployed into the sector in any 1 year. Now, if I was giving this presentation a year ago, what I would be talking about quite a lot is the significant tailwinds that were propelling our sector forward. Since Christmas, I think that mood and sentiment has changed somewhat, and we are now beginning to see a number of headwinds on the horizon. Those headwinds have been amplified even further by the situation in Ukraine, how that's impacted oil prices, how that has impacted global supply chains, and how that has impacted people's sentiment within the wider market. So I'll just talk through a couple of these just as we go. But on the headwind side, we have rapid and rising inflation across the continent and indeed across the world. That's important for a number of reasons, because it impacts the capital market side of things, but also crucially for the logistics sector, it impacts the consumer. We have to remember that 60% of occupier demand, give or take, as a pan-European average, comes from the retail sector. So take-up related to retail, online retail, grocery retail, all of the supply chain that goes with that. So 60% of our demand, roughly, comes from demand relating to the retail sector. So if the consumer is feeling less confident, then that will affect retailers, which history would tell us would impact occupier demand moving forward. Build costs are rising. I know that's a topic we're going to cover in the panel discussion. We have the situation in Ukraine. We have rising interest rates and how that impacts capital markets and pricing in particular. We have rising energy prices, which is another inflationary pressure to occupiers. The situation with COVID, as much as it feels like it's over in the UK and Europe, is actually far from over, and it's still having a big impact on global supply chains. We just have to look at China and their policies and how that's impacting imports and exports, and how global supply chains are reacting to that. And then in the UK, we have a very specific situation coming up with the business rates. There'll be a revaluation in 2023, and that again we expect is going to increase the occupational cost for occupiers and how much warehouse space they occupy. I'm not going to labour the point on the tailwinds too much because they are well spoken about over the last 2 years. We have the continued growth in online retail, which I'll talk about in a few slides' time. We have record low levels of vacancy. In the UK, it's just 2.8%, the lowest it's ever been. We have increasing levels of rental growth. It's worth noting that rents have never increased when vacancy has been above 12%. So if we have a vacancy rate of 2.8% in the UK, just over 3% in Europe, again, that shows you how far we are into landlord's territory when it comes to the relationship between rental growth and vacancy. We're seeing a rise in occupier requirements even now, even with the geopolitical situation that we have. And we are beginning to see the move from just in time to just in case. When COVID first came around, there was a lot of noise in the press, a lot of surveys, a lot of comments, a lot of commentary that this is what we would see. And for the best part of 18 months to 2 years, we didn't see any noticeable impact of this in our occupational data. We didn't see requirements talking about companies looking to nearshore and reshore. But as 2022 has progressed, we're beginning to see occupiers move away from crisis mode to more strategic thinking, and we're beginning to see occupiers look to bring operations back to Europe and take space accordingly. Just a little bit about the economy and where things are heading. This just shows you GDP growth across the Eurozone and then an inflation forecast for where things are heading. In many ways, I would treat this as a pinch of salt, because every presentation I've been doing recently, every time I've downloaded the data to do that presentation, by the time I've done the presentation, the data has been out of date. And this is probably no exception, because the data on inflation is changing with every new release of the data. Every forecast iteration that comes out, we see a change. The latest data that we're showing here is an expected avoidance of a recession and continued growth. Well, again, with every new iteration of the data that comes out, we see inflation rising, we see further pressure on the consumer. So, I would just say keep watching this data and how it's going to impact the market. But the point here is that we're already beginning to see interest rate rises in the UK, and we expect to see rate rises from the ECB into 2022 and 2023. And I mentioned consumer confidence, and I just bring up this data from Eurostat. They release monthly consumer confidence data, and this is the time series going back to 1985, and it's a question about how confident are you about your finances over the next 12 months. I guess the first thing to say is that the average is negative to start with. So as Europeans, we're not very confident anyway. But let's not joke around about this too much, because actually, if we look where the data has gone, particularly over the last 2 years, big fall after COVID, as we would expect, a recovery into positive territory, but then we were beginning to see a decline even before the situation with Ukraine came about. But then, as soon as that happened in February, we then saw another decline as well. And it's worth noting that whenever consumer confidence has reached the level that it has done in the last 3 months, a recession has always followed. We have seen a bit of an uptick in consumer confidence, but is that just a normalization of the situation in Ukraine and people accepting what's going on? I mentioned build costs, and I just want to show you this piece of data that we keep within Savills on build costs. Our project management teams keep a sentiment tracker of where build costs and project timescales are heading. And you can see here, this index that we keep has been at the highest level we've ever recorded over the last 5 quarters. Speaking to our project management team, they are expecting at least 2 years worth more of pressure on the availability of materials, the availability of labour, and again, that has an impact for our sector. Thinking about silver linings in all of this, however, for the logistics sector, the fact that it's very difficult to get hold of steel, concrete, timber, contractors, what that has the potential to do is to depress the level of development that we would ordinarily expect to see. So actually, this could have a slightly beneficial impact on the market, because it will keep the vacancy rate lower than we would ordinarily expect. If we buy into the thesis that low vacancy rates stimulates higher rental growth, then actually this could be a good thing in the wider context of the functioning of the market. And again, data on requirements. We track every single requirement in the market. This is UK only data. We don't have it for the European market, unfortunately, but I think it tells a good story nonetheless, that we can apply to what's going on. So we track every requirement in the market, and what's really interesting here is that since January 2020, we've logged almost 1 billion square feet of requirements. But if we just look at the Q1 data, we actually saw a rise in the number of requirements from occupiers that we tracked in that quarter. Now, if we suggest that on average it takes 9 to 12 months from a requirement to go to a deal, This would suggest that we should see an elevated level of take-up within the next 12 months. For me, this is one of the key indicators that I'm going to be watching like a hawk over the next year or so, because if we start to see the requirements data start to tail off, that would suggest to me that in 9 to 12 months' time, we should also expect take-up to also decline. But at the moment, this isn't happening, and we're actually seeing an elevated number of requirements, which should lead to an elevated number of deals. Now, I mentioned online retail. This is a forecast which we buy in from Forster. This forecast was produced in late 2020, and they haven't released an update to it since. But it's worth mentioning anyway, because this shows Western Europe online retail penetration. And if I just talk about the averages here for Western Europe, Forster were predicting that by 2025, the average level of online retail across Europe will be 25%, a dramatic rise to where it was pre-COVID. Now, clearly, a lot has changed since this forecast was produced, and what may now be the case, given the economic situation the continent and indeed the world finds itself in, is that maybe we won't get there by 2025. Maybe in reality it's going to be 2026, 2027. The point is, for us, and I'd ask you to consider the same, the trend broadly is still that we expect online retail to continue trending upwards. Whether we get to these levels as quick as we would have done pre-inflation, pre-Ukraine and so on remains to be seen. But overall, we expect the trend for online retail to continue trending upwards. And if we, again, buy into the thesis that every extra billion euros spent online requires 77,000 square metres of extra warehouse space, then for online retailers alone, we're going to need over 25 million square metres of warehouse space to accommodate that. And that doesn't include the likes of the parcel carriers, the logistics companies, and the whole ecosystem that goes with it. Now, I just want to show you some of the results from our inaugural logistics census, which we did last year with TritaxEuroBox and Analytica, and partnered with Richard and his team to promote the results. This was a survey that we did. We had over 400 responses from people across Europe, investors, developers, occupiers, agents. We're doing it again over the summer, so watch for our social media, watch your emails, and we'd really love your responses to this census as we gain a picture of what's going on in the market. But a couple of key points I just want to mention, because we asked people, were you in expansion mode? And 90% of the occupiers who responded to our survey said they expect to take more warehouse space over the next 2 years. So that is, again, a very positive leading indicator for where we are in the market at the moment. And where do we expect to take that space? Well, no great surprise, these are the countries with the biggest populations: Spain, Germany, France, Italy, and so on. This doesn't necessarily tell us anything we didn't already know, but it's nice to see it written down in hard facts that this is where occupiers are looking, this is where they expect to take more warehouse space over the next 2 years. Now, it's not just about online retail, because another element of our survey was asking people about the prospect of nearshoring and reshoring. And at the time of the survey, around a quarter to a third of the respondents said they were expecting to A, hold more inventory, and B, bring certain manufacturing processes back into Europe to mitigate for supply chain volatility. I suspect that when we do this survey again over the summer, the results for this will be even starker, and we'll see even more occupiers looking to do this. Again, there was another survey released the other day from the manufacturers' trade body in the UK, and over 60% of their respondents had said they are looking to nearshore and hold more inventory. So again, all of the mood music is pointing to this. Why is it important? Because if you bring manufacturing back into Europe, that creates a ripple effect. And we did some research during the COVID pandemic, but we found that for every £1 billion invested in manufacturing processes, that created a halo effect for demand in the supply chain. An additional 16,300 square metres of warehouse space needed to service those manufacturing processes. So it's worth bearing this in mind, that the story about logistics is not just about online retail, especially as we move towards mitigating manufacturing supply chain volatility. Okay, moving on to some data now on the market. If we just look, I already mentioned where take-up got to in 2021, record year. Again, if we look at 2022, we've had just over 10 million square metres of new leases signed across Europe in the first quarter of this year. It's a new record for a Q1. And what's really interesting is the level of demand we're seeing from different occupier bases. Using the UK as an example, we had a record level of take-up in the first quarter of this year. It smashed the previous record, which was set in 2018. What's also really interesting about that is that over the last 2 years, Amazon have accounted for about a quarter of the new leases signed in the UK. In the first quarter of this year, Amazon only accounted for 3% of take-up, 3% of take-up, and we still had a record quarter. So for me, what that demonstrates is actually how diverse the occupier mix is, what's driving occupiers at the moment, and how they're growing and adapting their supply chains to what's going on. And again, if we just look at where that take-up is across Europe, again, it's evenly balanced. We've got countries that we would expect, and we've got countries that we wouldn't expect. The Netherlands, small country but big catchment for logistics. Czech Republic as well. So a really interesting, broad, diverse, geographically and occupier mix for who's taking that space. Now, again, I mentioned earlier about slides that I'm going to be really monitoring over the next year or so. The data on requirements was one of them, but also the data on vacancy is another. I mentioned that rents have never increased when vacancy has been above 12%. Well, look, we have a vacancy rate of 3.3% in Europe at the moment. It's trending downwards in every market that we cover. Given the situation in the construction supply chain, given the situation in capital markets at the moment, and where pricing is and could be heading, which will be a topic for the panel, I do not see a speculative development-led oversupply of warehousing coming anytime soon. So all of that means that over the short to medium term, I don't see the vacancy rates lurching to levels that we saw post GFC. So that provides a level of comfort to the market because, again, if we think about rental growth, you have more chance of getting rental growth when the vacancy is low than it is high, even if we expect a couple of years of economic volatility as a result of what's going on at the moment. And again, it's worth noting, when the UK was at a similar state of online retail penetration than we're beginning to see in mainland Europe, the vacancy rate in the UK was 12%. So what we're now seeing is an e-commerce-led growth in demand in mainland Europe, but with the added impact of the lower vacancy rate that we didn't have in the UK 7 or 8 years ago. So effectively you're getting this pincer movement on the continent that we didn't have in the UK when we were at the same stage of the cycle. And just to illustrate this even further, this is some data from Capital Economics on rental growth. And for me, the econometric models on rental growth are missing some key points at the moment. These forecasts look at economic variables, inflation, unemployment, consumer spending, so on and so forth. What they're missing is a relationship between vacancy, take-up, and requirements. And For me, this is clearly too low because A, it doesn't tally up with what we're seeing on the ground, but B, it doesn't tally up with what we've seen in the UK, which we would use as a case study for the rest of Europe. This is what the forecasts were predicting for rental growth in 2021 at the end of 2020. Less than 2%, less than 1% in many markets. The red bars is what actually happened. You can see a mismatch, a huge mismatch. Again, the forecasts have caught up, but that's only because inflation has amplified the forecasts. And this is what I think will actually happen, because again, I can see no discernible change in the occupier metrics at the moment. And to illustrate this point even further, let's look at London as a case study. What you can see here is rents rising by almost 100% over the last decade, and vacancy plummeting over the last decade. So the relationship is clear to see. So if we have a vacancy rate of 3.3% in Europe that is trending downwards, and we have amplified demand, which we expect to remain broadly consistent, then we should see something similar evolve. And another data point from our survey is that occupiers are telling us that yes, location is key, building size is key, but also in their hierarchy of concerns, occupiers are becoming more concerned about good quality buildings with ESG features, and they are prepared to pay for that because the location of your building is of paramount importance in a market where there are significant inflationary pressures. On the capital market side, again, record level of investment in 2021, and we've seen a really strong start in 2022, and we expect that we're going to be there or thereabouts between 50 and 60 billion euros for 2022. And I know Marcus and the rest of the panel will discuss this in a few moments' time. Again, on pricing, as things stand, we have seen yields decrease, but again, where is that heading over the next 6 to 12 months? A topic for the panel, I'm sure. And I just want to leave you with two last points from the survey before I sit down. We asked occupiers what their biggest concern was, aside from COVID-19. Number one, the lack of supply of buildings. So again, that points us to a situation where this point about vacancy and supply is impacting occupiers' decision making. It was interesting to note that ESG features featured relatively low down the list for occupiers in our last survey. I suspect strongly that when we do our survey again over the summer, the rising price of energy, the rising price of fuel, that will come much higher up the survey when we do it in 2022. We asked broadly the same question to investors, and what was most important? Building location, covenant strength. Hardly a surprise, but ESG features much higher up the hierarchy on the capital markets side of our survey respondents. So that's me. I won't go through this because Richard's looking at me and wants to get up on the stage. Do reach out if you have any questions, and follow me on socials. I try and put out some interesting things from time to time. And I'll now hand over to Richard and the panel. Thank you very much.
Great, thanks very much, Kevin. Lots to pick up through there in the panel, I think, and a really good introduction to some of the topics. So if the speakers could come up, that would be great. For those who don't know me, my name's Richard Betts. I'm the publisher at Real Asset Media. We run around 60 to 70 of these events a year, publish Real Asset Insight, the Real Asset Day, and over the past year as well launched Real Asset Impact, looking at ESG, social impact, and that'll be one of the topics as well today, I think, because there's a huge amount of interest in that particular area. But let's start with introductions. Mike, let's start with you.
Yeah, hello, I'm Mike Forster. I'm head of UK logistics for Trammell company, and that is part of a new pan-European logistics platform that Trammell company have established in Spain, France, Germany, Czech Republic, and the UK, and I'm intention is to expand that into other charities fairly soon. Our rationale is we are a logistics trader developer. We are currently investing, purchasing as many sites as we possibly can in good core locations with a view to speculatively construct the product for many of the reasons that have been laid out in Kevin's deck earlier, and also looking at strategic land opportunities to bring through a pipeline in the future. We're well capitalised. Trammell Crow Company is the biggest commercial property developer in these states and have a very healthy balance sheet. That puts us in quite a competitive situation in the marketplace.
Brilliant, thanks very much. Marcus.
Hi everyone, Marcus Minckwitz at Savills. It's moments like this where I realise I need to update my photo or invest in a new face cream. But I've been here 14 years and now I run our EMEA Industrial and Logistics platform. Day job is capital markets, but we have offices and teams in every single country across Europe and across all the different service lines. And we've also actually just launched a EMEA data center team to kind of sit alongside us to cover that growing market as well. Just from a Savills point of view, UK is definitely our leading light, and we use that a lot, as you've just heard in our research, in terms of learning the lessons from the UK, where you've also got great data and great transparency on the market, to try and apply some of that to the European markets and what's going on out there.
Perfect. Interesting that around the data center side as well. Benoît, over to you.
Yes, hello everyone. So Benoît, I head BNP REIM UK London office. BNP REIM is a 29 billion asset management company. We manage all asset classes in Europe, logistic.
Maybe.
We're good.
It needs to be a little bit higher up, Benoît.
All right, is it better?
It's because you're so tall, you see.
Okay.
It's no problem I've got.
I'll start again, but maybe quicker. So 29 billion asset management, 350 employees in Europe. We invest into every asset classes, logistic. Within our portfolio, we have a bit more than 50 properties in every country. We are very active on asset class. We do that on behalf of funds, mandates, investors. We keep buying light industrial and logistic properties a bit everywhere. I guess we'll discuss that a bit later on. So for us, this is one of the favorite investments that we look at, but not as successful as it could be. So yeah, a lot of interest on this asset class, and a very interesting market right now.
Great, thanks very much. Mehdi.
Thank you. Good morning, everyone. I'm Mehdi Bourassi. I work for TritaxEuroBox PLC. We are listed pan-European investment company focused on the long-term investment in large big box assets. We are present in 7 countries throughout Europe, market cap of around 1 billion. And we've been growing very quickly. We've IPO'd in 2018, just over 4 years ago now. And yes, keen to capitalize on everything we've said on online penetration and reshoring. We see a lot of trends Kevin has mentioned being absolutely correct on the market. We see that happening.
Okay, great. Let's pick up, because there's a lot to get through, but it would be good, Mehdi, just to get yours and of course everybody else's view on that as well. I suppose, how do you characterise the first 6 months of 2022? Because there's been huge change, obviously.
I would split it into 2 things: the leasing occupation side and the capital market side. On the leasing side, I think it's a continuation of what we've seen over the last 2 years, if not accelerating. Still a very strong demand in logistics spaces, especially big boxes where we operate, and still a scarcity of demand. It's harder to get planning, to get zoning. Not many spec developments across Europe. It's very difficult to actually get zoning without a pre-let. And therefore, we see rents growing. We have evidence of that. We've just done a reletting in Germany near Frankfurt. We've seen 24% rent increase compared to a rent cent in 2019. So very, very strong. Now, on the capital market side, obviously, everyone is aware of rising interest rates, cost of debt rising, and everything else. And therefore, there is a bit of caution on the yield side. We know yields are at historical low levels. And on our side, we are a bit careful. We don't really know where things are going. Obviously, we know that when you were able to borrow, we issued a green bond, for example, midsummer last year, we're paying an all-in coupon of 0.95%, we wouldn't be able to do that. We would probably pay 150 to 200 bips today, and therefore it has an impact on returns, and therefore it has potentially an impact on yields. That being said, you have the driver of rental growth, which is counteracting that, and therefore there is a bit of an unknown on our side in terms of where the market is going.
Okay, good. And feel free to pick that up, anybody. But Mike, just coming to you, in terms of that balance between the headwinds and the tailwinds, I mean, how do you see that, particularly pick up that point on rental growth as well?
Yeah, I mean, it's a balance, isn't it, between the strength and the longevity of the tailwinds compared to the headwinds, and what your view of that is. My also view is that there are substantially strong headwinds at the moment, but most economic indicators are showing us that in terms of inflation, in terms of what's interest rates have actually risen to, say, in the UK, 1.75%, and done their job. Over the next 2-3 years, we're going to see those abate and inflation to come down. So the length of those headwinds are then believed to be as strong as the tailwinds, which is substantial in terms of the still massive divergence between supply and demand.
Okay, good. And Benoît, I just wanted to pick up with you. I mean, have you seen over the last 6 months, has that led to any kind of change or adjustment of your strategy looking at this particular sector? Because I know that obviously you're looking at it across the sectors, not just logistics. So it'd be interesting to see whether or not there's been an adjustment in terms of strategy, particularly for logistics versus, say, some of the other sectors.
Sure. I think what we've seen over the last 6 months is not so much about a change in our view on the sector, it's just how to adapt to the new conditions of the market. We're referring to the interest rates. I'll give you a simple example, but every 6 months we basically update our research and forecast on the different markets, and our view on logistics hasn't changed that much, except that we have to face some new realities, the interest rate being the biggest one, but I'm talking about also the inflation and the indexation clause in the lease agreement, which is also something that we are way more cautious about than we were a few months ago. But what we've done over the last 6 months, to give you an example, is we've been, again, very active, trying to buy, in the last year, something in France where we were outbid by the investors, so couldn't buy, but were willing to fight. We're working on a big portfolio around Christmas time in January in the UK, same thing, we're outbid, and that was a big deception on our side, but willing to fight. Then came February and March, again trying to buy something in Italy, same, very appealing property, but this is the first time we pulled out. And the main reason we did pull out was because of the mismatch between the yields and interest rates that we had to face. So I'd say still a very strong will to buy and to develop our portfolio, but facing a new reality. And I would have two interesting factors we now look at, which is the indexation clause on the lease agreement and the lease length. I think in line with what Kevin said a bit earlier, with such a low vacancy rate, I'm not sure the covenant strength that's interesting, but it may be a bit less relevant than it was or than it is on some other classes. We basically believe that if one tenant fails, we replace it. But we look way more cautiously at the indexation clause in the lease and how we can capture either the inflation or the rental increment on the market, which is something that, comparing this asset class with the other one, we didn't do in the past. We were way more interested on the covenant strength. We did buy a lot of those 10 years, 15 years income with the MSO and the H&M of this world. Now we're way more comfortable looking at slightly less solid covenants, but again, having a very decent approach to the modeling and looking at how to capture either the inflation or
Okay, good. I'm just going to pass that to you, Benoît, because although it is coming through, it's not coming through as well as it will do on that one for the next one. So, Marcus, just coming to you, how are you seeing that? Have you seen a sort of pause in terms of the capital? I mean, are you picking up as well? I mean, Benoît's there talking about, deals being changed, people coming back to it. What are you seeing in the market?
Yeah, I mean, quite bluntly, I think we are in the middle of a correction. We are seeing that play out in front of us right now. I think, though, you have to go back to where we were a year ago and look what was happening in processes. I mean, it was very normal to be seeing, we'd launch a sale, 100 NDAs. You could expect 25 plus bids, 3 rounds of bidding, every process going 25, 30 bips more than the last, numbers that people said no one would ever pay for a shed. As we approach this year, then that stopped. Processes were thinning. It was becoming a bit more normal, inverted commas. And then I think it's worsened since then. We're talking to enough of an educated audience that sit there running enough numbers to know the impact of doubling, tripling debt costs on your returns. Yeah, and I think that what we're seeing now is that play out. And where there are adjustments, it seems to be right at that core tight end. Buyers turning around and saying, I'm still going for the minimum lowest possible return I can get to still buy this shed, but quite frankly, I can't even get there on this price because of the rising cost. And that seems to be the correction at the moment. Now, turning to some positives is that, and we heard it from Kevin, actually business plans, I think people are improving those assumptions. I think rental growth forecasts are going up. We seem more confident in reletting prospects. Over in the US, people are paying more for vacant buildings than they are for let buildings. There's so much belief in the growth and so much money allocated that I don't think this is going to impact, our liquidity, our transaction volumes, etc. There just is a question mark on what your entry and your exit needs to be to kind of make it still work. But there's one final bit to add here is that, we do have the benefit sat upstairs that I sit next to my office colleagues, my retail colleagues, my hotel colleagues, my residential colleagues. And I think sometimes in these forums we get very dragged into a single sector, sometimes can switch off to what's going on in the world. Logistics is still coming out top. Other sectors are feeling these problems and issues far greater than we are because of wider concerns they have. They don't have the same benefit all the time to say, okay, so rising costs, let's pass that on to our occupier. We can move rents on. And I think that's one big plus for logistics moving forward when everything is facing these issues in terms of how we kind of continue to grow and take advantage of this kind of underlying structural change.
Okay, great. There's a couple of questions here online. One, which is around the sort of retail online thing, which I'll come to in a second, and it might be interesting to get your take on that as well, Kevin. But actually, a question directly for you, Mike, which is, I think it would be interesting to get a sense of, because obviously Trammell Crow big in the US. Are you seeing the same kind of headwinds and tailwinds in the US as you're seeing here in Europe, or is there a difference because of the proximity of, I suppose, the Ukraine war?
Same. And in fact, they've probably got them before us. So yeah, they are mirrored. I mean, they're not exactly the same, but certainly the same factors are at play in the States. And what Mark has just said, we tend to see it happening. We get a little sneak preview, as it were. What Mark has laid out there has been happening in the States for a few months, so we are getting a little sneak preview of what's coming, as it were. So yeah, the answer to the question is yeah, we do see it.
And so that very much suggests, Mike, in a way that there's two things happening here. We've got trends that were starting before 6 months ago, in a way that we're now beginning to see playing out, and then you've also got the Ukraine war and what's happened there. And has that led to any changes in terms of your view either of CEE or Germany or?
Not necessarily Germany. I can't really talk for the CEE, but I think what's important before we go on to that, the difference between what's happening here, slight differences in Europe and the States. The vacancy's low there as well, but we got to remember here the vacancy's 2%. It's a record low. That's what we're seeing here is that speculative product that's being built. I think in the UK we've got 40 million spec being built, but 6-7 million of that is already committed. So it's actually not coming to the market, it's not adding to the vacancy. So that vacancy is keeping low. And as Kevin alluded to in his report, the inquiries are still at a record level and don't seem to be abating. And interestingly, one takeaway is that the Amazon, we always worry about what happened if the Amazon factor was taken out. It has been taken out this year. We're still seeing those levels being maintained. So that is for quite a while leading to a long-running rental growth story in this country. Going to your point on Germany and the CEE, we're still seeing the same factors apply in those countries. So the effect, the long-term effect of we haven't seen necessarily just yet.
Okay, interesting. Is that the same true for everybody? I mean, Benoît, I know that you're actively looking at all of those markets.
Yeah, we have a bit of a different view, meaning that we would see or we would need an additional risk premium on some of those markets, definitely compared to where we were just 1 year ago. I don't think Germany would be impacted. Poland is a question mark, some of the CE market, definitely. But going back to what I said earlier, on our side, the will to invest is still there. I just think we need to adjust to those new market perimeters. But even in Germany, those markets are very interesting to us. Yep.
Okay, and Mehdi, I suppose, how do you see, because obviously you've got differing rates in terms of 10-year bond yields and those kinds of things, how do you see that, and is that influencing your strategy when you're looking at different markets?
It is, definitely, and to give you an example, the Polish 10-year bond rate is around 6.5 to 7%. So it does trigger the question, buying a share at 4.5, 5, 5.5, that actually makes sense from a financial point of view, actually having a negative premium to what is seen as a risk-free product, being a Polish government bond. On the other hand, the risk-free rate in Germany is 1.2, 1.3%, where actually it was 0% maybe a year ago. It has gone up. You still have quite a good premium versus what you could get in Germany in terms of prime logistics market. So yes, we definitely look at that, and it's part of our criteria, investment criteria in terms of picking the right countries.
Okay, good. And it'd be interesting, Marcus, maybe to get your view on, for example, if we're looking at some of the challenges there, there's a lot of discussion around energy pricing. Obviously, a lot of the logistics companies will be dependent on energy for transportation of goods, but also areas particularly like Germany, where it's been very strong and has a strong manufacturing base. They may well be, impacted more severely, I suppose, by these energy price rises. I mean, do you have a take on that? And Germany's normally been viewed very much as the safe haven for everything, but could this be an area of difficulty there?
Yeah, sure. I mean, I think just sorry, going back to CE slightly, just touching on that, because we spend a lot of time working out there. I think we shouldn't ever forget that Poland is the second biggest market now for logistics by take-up in Europe, and is forecast probably to become the second biggest market by volume in the next 5. Activity levels on the occupier side have only improved since this crisis, and also a lot of the perceived issues, particularly from an investor's point of view, going back through history around the behaviour of some dominant developers, the way in which incentives were offered, that big issue around headline to net effective, picking tenants up and moving them so easily, that's kind of disappeared a little bit overnight because simply you can't get the numbers to work through that kind of behaviour. So the fundamentals there are pretty sound. I think the bit on kind of the risk-free rate, which I subscribe to completely, but I think you've got to realise as well, in Poland, your euro-denominated leases, it's German banks lending. If you're buying Western Poland, you're actually buying into the German consumer market. If you look at that Amazon banana, that's 80% of those goods going right back into Germany. So it's a different dynamic. The issue is just liquidity. Much easier for a fund manager just to say no, given the geopolitical risk. And we've got a job to convince people into that growth story out there as well, but that does come with a discount. It has to, I think. I think then it does link into the energy piece and rising costs generally. We are about to launch a paper on rent affordability. It's one of the biggest topic, I guess, people asking, how are these rents sustainable? How can we confidently say 5, 10, 20%, 100% rental growth in London is sustainable? We saw what happened in retail when rents went up by that level. Everyone eventually turned around and said, sorry, we can't afford these. Now, the good thing is for logistics is rent is such a lower portion of cost. And my spin on it, my take on it, I shouldn't be spinning anything, but it's not about affordability of the rent, it's about general cost management. So all costs are going up, and that is squeezing kind of people's margins and pressures. Rent is something that can help you, or real estate, sorry, is something that can help you manage costs elsewhere. So if you look generally, transport and labour are probably the two biggest costs. You know, if you have a better located warehouse, the saving you can make on your transport costs massively outweighs kind of the premium that you would pay for your rent. And I think that's kind of the biggest thing as we go into this, is that getting the supply chain right, getting your warehouse right, pieces then come into sustainability, energy management, etc. But that's pretty critical for just general profitability and performance among the occupier base. And I think that's another real positive for the sector going forward compared to some of the others that are kind of probably more exposed to single market dynamics.
Okay, good. I wanted to pick up, there was a question as well around online retail. Kevin, you mentioned there that there may be a delay in that growth coming through. And there was a question online almost immediately after you'd said that, actually, which I've saved until this point, which was, would it, is that delay around the fact that people may be shopping less, or is it that it will change people's attitude? The question here was, probably people are still going to continue moving online. So why do you think there will be that delay?
So I think the biggest reason is if you look at where retail sales are heading as a whole, we're looking at a plateau, and in some markets, can you hear me?
I can't, it may just...
Shall I come up to the lectern?
Come up to the lectern, yes, why not?
Why not? Back to where I started. So to answer that question, if you go back to the GFC and what happened with online retail then, online retail was very much in growth, particularly in the States, the UK, China, and some of the other countries. So whilst you may have seen a contraction in retail sales in the GFC recession, online retail was still growing from a very low base, so it was taking a bigger portion of what was essentially a smaller pie. If we look now, particularly at the more developed online retail economies, any fall in total retail sales is going to be much keenly felt, because online retail is a much bigger part of the total retail landscape. And you just have to see over the last 6 or so months where we've seen some failures in the online retail world because of what's going on, supply chain pressures, rising costs, and falling sales. So now, more so compared to before, online retail is much more linked to the wider economic cycle. That being said, I believe the overall trajectory for online retail remains. We hosted a webinar back in January, and we invited the former CEO of Amazon in the UK to speak, a chap called Brian McBride. And he was CEO of Amazon for 5 or 6 years in the UK. Actually, no, probably longer than that. He was chairman of ASOS, and was a real critical thinker in this sector. And somebody asked him the question, where do you see online retail getting to? Where will it plateau? And he said, well, I can tell you that Amazon is working on the assumption that online retail will get to 50% of all retail. Now, he wouldn't be drawn on when that would happen, but he said that is what they are working to, and what other retailers are working to as well. So, taking a step back, my instinct tells me that the trend remains the same, and even if we are in for that period of economic volatility, volatile retail sales, and so on, we still should be expecting that overall the online retail penetration rates are going to continue increasing. So just to reiterate the question to the online audience, so the question relates to if we continue to see elevated levels of inflation, what will that do to... No, and I don't think anybody can accurately forecast, over the next 15, 20-year period. All I can point to is the forecasting and the consensus forecasting that we have access to, and which suggests that the inflationary pressures will start to ease over the next 2 to 3 years. So clearly, we don't know what black swan events are on the horizon. There have been more in the last 2 years than I can ever remember. So I think, it's very difficult to have a long-term horizon on that. And I would just ask anybody, particularly when they come to online retail penetration rates, do you see yourself spending more or less online in the future? I know where I sit on that question. And I think everybody probably knows the answer as well. So as I made the point in my presentation, if it's 2025, then so be it. But if it ends up being 2028 that we get to that 25%, it's still going to have a dramatic impact on our market.
And go ahead.
To what extent? Yeah, to what extent? We've seen massive liquidity in this market, since the GFC. Central banks have just been printing money like it's going out of fashion. We see easy credit where anyone, it's almost like, the housing crisis, we saw in the US, where people could buy a house, without having any, credit rating at all. Surely all of this stuff is going to conspire to make life extremely difficult, for retail. We seem as though we're in a sort of a perfect storm. Costs, for the consumer are rising exponentially, mortgage costs, food costs, everything, is going up. There's a limit, I would have thought.
Yeah, so, I could probably pick up a little bit on that. And before I did sheds, I tried to sell shops for a living, and retail warehousing, back in 15, 16, when e-commerce was hitting. I think that you're absolutely right, and I think we have to accept that macroeconomic issues, crisis, logistics can't be immune to that. It's just that what role does it have in helping us overcome those issues? And the retail portfolio, the physical retail portfolio is far more exposed to that, right at the front line. E-commerce actually is a way of overcoming some of those issues. E-commerce was born through the GFC, and it helps you cost manage, it helps you compare, it helps you stop yourself having to pay the petrol to go to the shops. There's a lot to be said for e-commerce in a recession. And I think that, obviously we're heading that way. So the other big bit around that is then how do the occupier base react to some of those pressures? And everything we're seeing is that it's better management of their warehouse space, and often more warehouse space. And that's kind of the underlying point here, is that you look at deglobalization, et cetera, a lot of it points towards the need for more warehouse space, which is a relatively low cost in the grand scheme of things. So where there will be some disruption, there is definitely already going to be some insolvency, there's going to be some disruption around the occupier base in certain markets, probably some displacement out of some really expensive markets where people can't afford it. But we're also coming off a 2% vacancy rate. And as Kevin said, we've seen anything below a 12% vacancy rate you would term a landlord-friendly market. So we've got a lot of headroom in the system to account for kind of some of those big shocks that are undoubtedly going to come.
Would you not be sort of concerned a bit, let's say looking at the States, and probably this is in sort of Mike's area, of, people like Walmart and Target, who've obviously, carried, fairly significant inventories, and are now having to effectively, dump that, and that kind of reflects, where the sort of retail demand is sort of going at the moment.
Yeah, you're in the States as well. The one thing with the States, and we've just done a piece on the Amazon piece, they just overexpose themselves generally to everything. It was the same with retail. There was always 6 times more retail space per capita than in Europe. It's the same with Amazon. We've got that slide. There's way more overexposure in the States than there ever is when you talk about the European continent.
We have actually a Barclays note, a research analyst note, because Amazon have come to market a few weeks back, actually depressing a bit the listed space on logistics. And we dig into the amount of space Amazon has per capita in the US versus Europe. And actually the amount is 7 times bigger in the US. So we always think about Amazon and online penetration in the US. They are far ahead, and Europe is really behind. In Europe, you wouldn't be surprised meeting people having not any Amazon app on the phone, not ordering from Amazon. And forget that here in the UK because it's part of our lives. But actually, a lot of people actually don't order from Amazon. Amazon is not in the Netherlands, for example. And when Amazon gets into a market, they disrupt the entire ecosystem. Everyone has to adapt. All the in-store retailers have to become omnichannel, and they have to compete. And yes, the overall pie, total sales, retail, could decrease because of inflation and everything, but actually the part online, we don't see increasing.
Yeah, I was just going to add that the Amazon store is a unique one, and you're right, they have expanded at a stellar rate more than they needed to. I think they may be behind that. They never want to be in a position where they did not have space. They'd rather be in a position where they're backfilling space as they are now, rather than not being able to grab because they didn't have enough space. They're quite a unique story. One thing no one ever talks about is obsolescence of existing buildings that need replacing, and that's where vacancy is really hitting. We always talk about new demand and how e-commerce, and it's quite right, e-commerce is driving this, and from 3PLs to online retailers, how they're increasing their demand. But there's a substantial estate within certainly the 3PLs and retailers where obsolete space needs to be replaced, and that's always come to market at the same time with low vacancy rates. That's a major factor as well, which we never really talk about much.
I just want to jump in on the point very well made about Walmart and Target in the US. I spend a lot of time going to logistics conferences and trade shows. I'm a bit of a geek like that. And what's really interesting is all of the logistics industry at the moment is talking about supply chain resilience and inventory resilience. And clearly with some of the American retailers in particular, they were faced with a very interesting cocktail of very high consumer demand, very uncertain ways of getting product into the country, and not really knowing where demand was going to be further down the line. And so they took the decision to increase their inventory levels as a result. Now, interestingly, I was reading about Target just this morning on the train, and they've said, well, okay, so we're going to have to write down some of our inventory and so on. But they also said that they're going to start taking more warehouse space near the ports in the States, so that they can have better access to the goods when it comes in and be able to distribute it. Now, the problem with inventory management, particularly for online retailers, is that if you don't hold the inventory, you haven't got a business anymore. Take some online retailers whose model was, furniture in particular, good example. You'd place an order, and it would then come 12 weeks later, sourced from Asia or North Africa or wherever it might be. Now, because those lead times are so volatile and uncertain, and there's very little brand loyalty for the consumer to online retailers, they're saying, well, actually, we need to actually hold the inventory if we've got any chance of making a sale. Now, that goes against historic principles where you don't want to be holding the inventory, but then historically, supply chains were much more secure, and everything happened when it was meant to happen. So there's this whole balancing act going on, which in the short to medium term is generally speaking, going to push us to higher inventory levels and therefore higher amounts of warehouse space. Now, it may be in 6, 7, 8 years when this settles down, which it will be that long, that people can go back to a more usual, by historic terms, level of inventory holdings and knowing where things are going. Does that mean in a decade's time, that we'll see a rapid rise in vacancy when people know more about what's going on? But I think at this precise moment, again, going back to the Black Swan events and how everything's reacting, people have made that decision about inventory security, and they're faced now with some potential headaches as a result of that.
Interesting, thank you, Kevin. And we'll pick that up. I did want to say that one message from me in terms of the availability of things online. I did once buy a pair of shoes online before going to Expo Real, and that was, I can tell you, was a very fundamental mistake, so don't ever do that. I wanted to pick up a little bit on the development side. So I guess, interesting that we've got those kind of drivers of, supply chains, more inventory, a lot of drivers from that point of view. I mean, what do we see at the moment for development? Because obviously you've got construction costs rising, you've got inflation rising, all of those things potentially putting financial pressure on whether or not a development is viable. So what are we seeing at the moment, and what are we expecting to see? Maybe let's start with you and then...
Yeah, there's a couple of things. And actually, Mark's picked it up before. We're in this period at the moment where we have visibility of what the rising costs are, and we have visibility of what the rental growth prospects are, and we have an understanding where we think yields are. But the effect of those rising costs really pare down to what you should be paying for the land, and actually we're at a point where sellers' expectations are still there 5-6 months ago, and we've moved on with what the reality is, and we're in this period where those are starting to use the phrase adjustment. There is an adjustment going on. So firstly, it's the actual cost you're paying for the development in the first place that is starting to change. And we've seen, anecdotally in the market, a number of deals coming back which have been renegotiated from best bids. The other thing is just a laser focus on the sensitivity. We've always focused on sensitivity, but now absolutely laser focus when you look at it in terms of, okay, what if this really does go out 25 bips or even 50 bips? Are we still in a position where the returns aren't as good, but they're still good enough to keep going with us? That's one thing in our sort of thinking. I think that generally, build costs, we're going through another tender process at the moment, and we're starting to see, the 16 to 20% spike in build costs of last year. We're starting to see that abate. Costs are still rising, but we are seeing that come back to a relatively decent level. And probably the key factor there in the development is, managing the cost is one, but then fixing into a GMP is one, but it's actually the financial covenant of the actual contractor that you're using. That's a very important point in our sort of our development program. But generally, because of going back to the massive imbalance between the supply and demand, if they're good locations, locations not just with motorway backing, good labour supplies, that's a very, very key point for the occupiers. But there's still room for plenty of spec in the UK market anyway to come through before that imbalance is corrected, before we start heading towards more 8, 9, 10% vacancy. We're a long way from there. Spec developments is still works.
Okay, good. Does anybody else want to pick up that?
No, I guess for us as an investor to comment, we would mainly buy forward funding from developers. So the main change we'll be way more cautious on the strength and the solidity of the counterparts. So when maybe 2 or 3 years ago, the developer was something very important in the deal, but maybe less. Now we'll be way more cautious on that. And the second point is, again, appetite from investor, even for spec development for the obsolescence and ESG topics that we've started to talk about, which is for us on the long run a very important tailwind. We just know that this is the best way to get access to grade A properties in Europe. So yeah, selecting the developers, but still appetite for that.
Okay, good. Mehdi, maybe coming to you, I mean, pick up that point around development, but also, I mean, an interesting point raised there, I think, by Mike around the sort of green versus brownfield development sites, obviously, and ESG playing a big role there, and also planning, of course.
Yeah, we are not a developer as such, so nowhere near as much experience as Mike, but what we see on the ground, at least in Europe, in continental Europe, is a lot of pressure on the ESG side, especially for the planning and zoning. It's actually quite different in the UK, where a lot of the zoning is done locally by the local mayor, and they have they get a lot of pressure from green lobbies, which are a lot stronger than what we have here, and we see less and less actually greenfield development going forward, a lot more onto redevelopment, which means high costs, which means it needs to be taken into account into the equation, I guess, and to make the returns work. So yes, it's increasingly important, not just for the developers, obviously, for the local communities, for the investors, for the tenants as well. As we heard earlier from Kevin, tenants are prepared to pay a bit more for green or ESG friendly products. It's not just green, it's also S side is important. Attract labor to keep employees. It's increasingly important to actually make buildings appealing to a wide range of occupiers.
Yeah, it's critical for us that the BM excellence and the ESG credentials, not just for the investors, but the occupiers.
And is that also going to play into energy as well, the requirement, because obviously we've got increasing energy costs at the moment, so presumably as well, the more you can be driving energy yourself off shed roofs, off those kinds of things using solar is going to be more important.
Yes, most definitely.
Albeit that's changing as well. I mean, I need to read up a bit more on it, but I was told in Spain in the last week or two, they kind of turned off the PV debate by saying that there won't be any buyback from the grid, which is how you're kind of justifying this. And that's going to be an emerging thing as this extends out. But I think, interestingly, on the development piece, it seems to be the new phrase of the year is covered land. That's kind of lots of calls from investors now building covered land strategies. So, anything that, any use, any purpose that could theoretically become a shed, where standing investment basically is sub-residual land value for logistics. And I sat in a room yesterday with a big owner of sheds in London, and they're buying schemes that were designed for 6-story residential to build single-story sheds.
That's happening. We're looking at all sorts from hotels to offices to all sorts of asset classes we're converting to.
And I didn't say in the room, I was like, so what's the planning risk there? And I said, well, it's allocated either kind of employment or residential, so we're not so concerned. We're more concerned as whether or not we'll hit 50 quid a foot. And that's kind of the real inner city, big urban locations. It really, really is just the top big cities in London, in Europe at the moment where this is paying out. That is the next push in terms of satisfying demand from occupiers.
And just to be clear, that's not part of a mixed use development. That is what could be zoned for something significantly larger that is just being used for.
I mean, I think you only go to mixed use if you really have to. If you can get in and out building a single-story shed, why would you overcomplicate it? It used to be the general view. We had our residential colleagues in the room saying that they've dropped residential from their development surveying titles because they're now having just to admit that it could be to any use class at the moment. Data centres are another big one that are trumping values for traditional uses over and over again.
And I was interested as well. I'd be interested to see what your views are as well, Benoît and Mehdi. I mean, Mike was mentioning earlier about that there are now much older logistics assets, whereas you get the feeling maybe a year ago that it was any logistics asset was a great asset to have. What's the sense now? Is there much more of a focus on maybe looking at each asset by asset on a granular level to see what it's like, where it's positioned? Is that more of a focus? Was it always a focus?
It was always a focus. I think with the inflation that we're facing, it will be more, because going back to one comment that was made, for the operating company that will use the facility, if it's not to the best standards, we know that it will impact their cost base more, so will be
even more cautious than we were on the quality of the property.
But that being said, if you compare it to like office or retail or whatever, like think about it, a lot of these sheds are very simple boxes, 4 walls and a roof, and actually it's not that expensive to bring maybe a shed which is not green to actually good standard. It doesn't require a lot of capex, and if you compare that to what it costs to actually bring an office space, which is, you have that debate as well on the listed space where like question mark as to how much capex is required for the big occupiers or landlords here in London to bring office space to a correct EPC rating. Actually, you don't have that much of that on the logistics space because the capex requirement is not as much, and the obsolescence is not as much. You don't have, like, very often you have contracts where the tenant is in charge of a lot of the maintenance. They keep the buildings in very good condition, and overall, beside the machines which are inside, which has a lot of obsolescence, which we try not to own, actually owning just the full wall and the roof doesn't require a lot of capex.
But a lot of the obsolescence I was talking about was surrounding height, which is much more difficult to address. I.e., by that I mean a lot of people that pride themselves to 3BLs for this online expansion. A lot of their estates still 8-9 meters in the UK. Sorry, feedback on that. They need more than that.
And so what's the option with that? I mean, new. Okay. So that's got to be a demolish and rebuild, basically.
Yeah, I think just picking up on the ESG, just on the ESG point, we're at a bit of an inflection point. At the moment, we're selling buildings, and in our IMs, we put quite a nice 2-page together in terms of what you can do to improve the ESG credentials of this building. And that building is still liquid. You know, I think investors or buyers are forgiving of the fact that a building might not be perfect from an ESG point of view today, and we'll take that on. I think that in probably 12, 24 months, it will be, well, why haven't you done that? You know, and if you're going to bring it to market, you need to have done that to make it liquid, to make it core, to make it worth, you know, what we're suggesting it is. And I think that's kind of the point we're at now, is a lot of people are having to look inside their portfolios and think, well, what do we need to do to improve this, rather than simply saying that's for the next guy to take on.
Okay, good. I wanted to talk a little bit, just briefly, around the opportunities side. We've talked a lot around the trends, and that leads us obviously to thinking about some of the opportunities. But just for everybody, I suppose, where do you see the biggest opportunities at the moment, looking into the second half of the year, but also going beyond that? Let's start with you, Mike. I mean, what are you seeing at the moment?
We're actually seeing quite a lot of stock. So the actual sort of availability of stock is an issue. Getting hands on it due to the competitive nature of the market is the issue. We're running a two-track strategy. One is what I call oven-ready or near oven-ready acquisitions. And that can be green or brownfield. It happens that 3 or 4 sites we've bought already are brownfield ones, but the strategies are either green or brown, as long as it's got a good planning prognosis. But also, as the opportunity is for us, making sure we have looking after our pipeline in the future, so longer term strategic land, which we can bring forward over 3 to 5 year period. So those are 2 sort of areas of focus in terms of opportunities for us.
Okay, great. Marcus?
Everywhere, yeah. No, I'm a broker. I think generally, now if you look at standing investment stock of rent that was set, 4 or 5 years ago, a lot of that now is sub-replacement cost. And everything we've heard today, pressures of finding land, building new stock, there's a lot of signs for growth, in those assets going forward. You just have to be prepared, in my view, to take a slightly longer term outlook to kind of find those interesting opportunities, because I think there's so much kind of activity and, chasing, if you like, of the short income, the reversionary story inside 3 or 4 years. And it doesn't always exist, particularly on the continent, given the lease structures. So I think if you've got a longer term view and you're just buying really well located, sensible, rented assets, then there should be a lot to come from those looking forward, but just on a slightly longer term horizon.
Okay, great. Benoît?
So we're lucky enough to be longer term, so hopefully we'll do good in the coming few semesters. From a country perspective, we're slightly more bullish on the UK compared to continental Europe, but still overall, again, bullish on the asset class. I think what will be again interesting for us in the coming few months is with the different shocks that have been described this morning, plus there are some additional ones. We didn't talk about the tech stock market and its impact on the funding of a lot of online retailers, dark kitchen players. I mean, there is a new ecosystem with some subsectors within logistics, last mile, and again, new smaller niches where we'd like to enter. But again, we need now to better understand what could be the impact of those different shocks. And I'm sure there will be new opportunities and interesting markets to play in the logistics field.
Great, Mehdi.
On our side, we see asset management on our portfolio being the biggest driver, trying to capture the income growth. It's all nice to talk about market rental growth, but it's important to capture it as well. And when you have very long leases where you just have indexation, where you have historically in Europe, you have indexation clauses which are not always landlord friendly, where you have hurdles where they don't capture 100%. Basically, you need to create these leasing events to actually capture the rental growth, and that will be our focus in the next 12 months, is actually to blend longer leases for the security. It's always good to have some security, but actually trying to blend with shorter leases to actually get that additional income and ride the wave of the rental growth we see coming. And we think it's increasing, and it will be probably faster than what people think.
Okay, great. Really interesting. Thanks very much for all of your questions here and your comments. Thank you as well to the audience online for your comments. The conversation will continue now next door over coffees and teas. The speakers will all be here so you can ask them questions. So do feel free to do that. And online you can continue with I suppose, making your own coffee, but you can still continue the conversation online. And if you're watching this on demand, thanks very much for watching. Thank you, everybody. You can, if you have colleagues who are in Amsterdam or you're visiting Pravada, we're there next week running a couple of sessions focused on ESG and social impact. And then we'll be back again in London with an outlook across the sectors at the end of the month, and also a focus on infrastructure as part of the sort of real assets structure, coming up, and that's in July. In July, yes. So do feel free to join us for those. And in the meantime, if you could join me in thanking yourselves and the speakers, that would be great. Thank you very much, everybody.